Welcome to our presentation on tax effect accounting. So this morning we'll be looking at the mechanics of the balance sheet approach to accounting for income taxes. We'll look at how you will calculate your current and deferred taxes under WSB 112. We'll look at when you would recognize or not recognize your deferred tax assets and liabilities. Then to break it up a little bit, we'll show you how corporate groups use software to account for their income taxes in their financial statements. We'll then look at some special topics, and that would be accounting for tax consolidations. And we'll also touch on recent changes to WSB 112 and changes that will come through sometime in the future. So you'll probably hear concepts like permanent differences and timing differences. These were terminologies used back in 2005. These terms are no longer used. The terms that are used in WSB 112 is a concept of temporary differences and non-temporary differences, and you have a concept of tax base of assets and liabilities. Now, as the name suggests, the focus is on the balance sheet to calculate your deferred tax asset and deferred tax liability. You also need to calculate your current and deferred income tax expense, and we'll go through what those are. So as I mentioned, income tax expense now is required to be broken up between its two components. One is the current tax expense, and the other is the deferred tax expense. The concepts are really quite simple. The current tax expense is merely your corporate tax rate multiplied by your taxable income. That's it. Right? That's the tax that you pay to the ATO in the current year. Taxable income multiplied by your corporate tax rate. The deferred tax expense is, broadly speaking, you take your opening deferred tax asset balance, deferred tax asset and deferred tax liability, take your closing balance, deferred tax assets and liabilities. The non-equity movement is your deferred tax expense number. Okay? And we'll talk about what equity movements are in the special topics. So if you take current tax expense add your deferred tax expense, the combination of those two amounts gives you your income tax expense. Current tax expense is generally have to be positive. Deferred tax expense, because it's the movements in your balances, could be positive or negative. Generally negative. So the combination of both gives you your income tax expense. Okay, so what I might start with is the calculation of deferred tax assets and deferred tax liabilities under WSB 112. Now, as I mentioned, the focus is on your balance sheet to calculate your deferred tax assets and deferred tax liabilities. So I'll just go through the screen pretty quickly, and we'll look at the elements one by one. So to calculate your deferred tax assets and deferred tax liabilities, you start with your balance sheet. You take your balance sheet, which contains the carrying amount of your assets and liabilities. From each of those items on your balance sheet, you subtract the tax base of the relevant asset and liability, which will give you what's called a temporary difference. You then ask yourself whether or not the recognition criteria or the recognition exceptions are applicable or not. If they don't apply, multiply the temporary difference by the tax rate, and then you'll get your deferred tax asset and your deferred tax liability. So let's go through the elements one by one. So firstly, you start with the carrying amount of your assets and liabilities. The carrying amount is your book value, your whatever is sitting on your balance sheet or your trial balance. Now you note that you would have already put through all your adjustments before you do tax. And what are those adjustments? Your impairment charges, your revaluations, all those foreign currency translations, all those need to go through before you do your tax. So tax is a final adjustment. Now from each of those assets and liabilities, every single one of them, you got to ask yourself, what is the tax base of those assets and liabilities? So I'm going to discuss the concept of tax base from three perspectives. One is that you can work out your tax base according to our understanding of the income tax concepts. Secondly, I will give you a formula to check your tax base calculation. And thirdly, I'm going to show you how management intention as to how you're going to make money from that asset can affect the tax base calculation. So 3 points I'm going to cover in terms of tax base. Now, firstly, tax base is really similar to our understanding of tax concepts. So if you have a plant and equipment, the relevant tax value that you use to calculate your depreciation would be your adjustable values or written down values. That is the tax base for plant and equipment. For CGT assets, the relevant tax concept would be your cost base in calculating the capital gains or losses. That is subject to management intention, is the tax base of that asset. If you got trading stock, it would be whatever you use for your tax return purposes. That's your cost, market selling value, or your replacement value, whatever that value that you use. The flip side of it is liability. When you look at a liability, the tax base can be either one or two. It either be equal to what you have in your balance sheet, being the carrying amount, or it could be zero. Yep. So if you have a liability that you add back in your tax reconciliation statement, that is a liability that is not incurred for tax purposes, such as a provision for annual leave or audit fee accrual, the tax base would either be carrying amount or zero. So anyone want to make a guess what that would be? The tax base, it would be zero. Yep. It's not a liability for tax purposes. So the tax base for a liability that is not incurred for tax purposes would be zero. If you have a liability where there are no tax consequences when you pay that liability, such as a bank loan, the tax base will equal the carrying amount. Okay, so that's the liability side of things. So what I've demonstrated is that you can work out the tax base pretty quickly yourself. All right. Now, second thing that I want to discuss is I'm going to give you some formulas to work out the tax base of assets and liabilities if you do want to check them. Okay, the tax base of an asset, if you want to check the calculation, is whatever you start with the carrying amount, whatever is sitting on your balance sheet, minus the money that you're going to get from that asset, which is the future assessable amount, plus any future deduction that you're going to get. The future assessable amount is very simple. The standard says, assume your future assessable amount is your carrying amount. You always recover the amount equal to the carrying amount. So these two are always the same. And then you add your future deductible amount. So let's look at an example. Let's say you have plant and equipment with carrying amount of 100 and tax written down value of 80. So we use the formula. The carrying amount of the asset is 100. You're going to make money of 100 always. The standard says assume that's the case all the time. And the future deduction that you're going to get from that asset would be 80, yes. Okay, so the tax base is 80. Now, in terms of liability, it is the carrying amount minus future deduction that you're going to get. when you pay that liability, when you settle that liability. So let's look at a provision for annual leave of 1,000. What's the tax base of the provision for annual leave? You got carrying amount of 1,000. How much deduction that are you gonna get when you pay that provision? You're gonna get 1,000. Yeah. So the tax base is 0. Let me give you another example. Let's say it's not a provision for annual leave. Let's say this is a provision for environmental fines that you're gonna pay. So the carrying amount is 1,000. How much deduction are you gonna get when you pay those fines? 0. Yep. So the tax base is 1,000. The thing that I want to demonstrate to you is that just because you call something a provision or accrual does not make the tax base 0. Yep. You're gonna think about whether or not you get a deduction from the settlement of that liability. The last two here is the tax base of prepaid expenses and tax base of prepaid income. And it's a bit different the way you calculate. The carrying amount of prepaid expenses would be, the tax base of a prepaid expense would be the carrying amount minus what you have already deducted in your tax reg. Yep. And tax base of a prepaid income would be the carrying amount minus what you have already said is derived in advance for tax purposes already assessed. So that's those are the formulas for you to check the tax base of assets and liabilities. Now the third thing I want to cover, which unfortunately is still a relevant concept, is how management intention as to how they're going to recover the value or make money from that asset is going to affect your tax base calculation. So if you have a rental property, there are two ways that you can make money out of that rental property, turn it into cash. The quickest way is to sell it. The second way is to, takes longer, rent it out, use it. Okay? So you can either sell or you can use it. So let's see how management intention can affect the tax base of an asset. Let's say you have an old building. It's 100 million. It costs 100 million, and that's what the carrying amount is at the moment. The building is very old. Division 43 deduction is 0. Forget about the land component. Just assume this is all building. Now there are two ways that we can recover the asset. One, as I said, is by selling that asset. So under the sale scenario, let's work out what the tax base of that asset is. So I've got a carrying amount of 100 million. I'm going to make money from selling it. I'm always going to sell it for 100 million. That's what the standard tells me. So that's 100 million for future accessible amount. To subtract against my sales proceeds, I have my CGT cost base, which is 100 million. So that gives me a tax base of 100 million. So if you recall, the way we calculate the temporary difference is carrying amount minus tax base, gives you a temporary difference. So carrying amount is 100 million, tax base is 100 million, 0 temporary difference, 0 deferred tax liability. Are you happy with that? Yep. Okay. Now under the use scenario, I'm going to generate 100 million of rent, sales proceeds, service income. Carrying amount, I'm going to generate sales, service income, 100 million. Because division 43 deductions is 0, the future deduction that I'm going to get from that asset is 0. Yep. So my tax base is 0. So under the use scenario, I got a carrying amount of 100 million. I got a tax base of 0. I got a temporary difference of 100 million. Deferred tax liability of 30 million. A huge issue
for a lot of companies, especially where they got assets that are rollover, have a very low cost base, etc. So if you got a sale or use scenario, it results in a different deferred tax liability balance. So faced with this scenario, your auditors will come to you and say, are you going to recover it by way of sale, or are you going to recover it by way of use? And perhaps you're going to say sale, isn't it? You probably say sale because that means that you don't have a DTL. It's not as simple as that. Whether it's sale or use depends on whether you depreciate that asset. If you don't depreciate that asset, then you are intending to recover it through sale. If you're depreciating it, then you're going to recover it through use. All right, so that's how you differentiate between the two. Now, so we discussed the three concepts in relation to tax base. The difference between the carrying amount and the tax base gives you the temporary difference. If you think about the formula, if you have a look at the formula, you start with the carrying amount of your asset, you minus the tax base of your asset, gives you a temporary difference. If you think about it, a temporary difference can only be four things. Yeah, it can only be one of four things. One is an unrealized capital gain or loss. Yeah. Sorry, one is unrealized gain, unrealized capital gain, or it could be an unrealized loss, capital or revenue loss. It could be a future deduction, or it could be a future accessible income. It has to be one of those four things. Okay, so if you are having a temporary difference calculation and you can see that it's neither of these four things, then you probably have to check your tax base calculation. Yeah. So once you have a temporary difference, you look at your recognition criteria and your recognition exceptions. If they're not applicable, you multiply the temporary difference by your tax rate, and you get a deferred tax asset or deferred tax liability. Okay. So that's the DTA DTL calculation. So next, what we're going to do is let's look at a simple example to get an understanding of the current tax expense and deferred tax expense and how that is calculated. So have a look at the example on the screen. Firstly, we need to calculate our current tax expense. So we start with our profit. Add back our fines. Add back the closing annual leave provision. That's just 0. Subtract the opening. That should give me 1120. Is that right? Yep. Hope that's right. I'm a tax partner. Now, current tax expense. What is it? It's 30% by taxable income. Yeah. So 30% of that gives us 336. So the first journal entry is to debit current tax expense of 336, credit current tax liability or your provision for income tax of 336. So this is a debit, so it's a positive amount, 336. Next is our DTA. So our opening DTA is 30. Are you happy with that? Yep. Our closing DTA is 36. So it's increased by 6. We need to debit our DTA by 6. Yep. So I go debit deferred tax asset. And what I've said opening DTA, moving to closing DTA gives you your deferred tax expense. You see on the back it's 30 there. And because it's a credit to deferred tax expense, it's a negative, gives me income tax expense of $330. So the calculations itself is actually quite simple. But I think if you probably have found that the difficult part of tax effect accounting is the reconciliations that you need to make. Reconciliations that you need to make sure that your disclosure notes make sense. So that's probably the harder part of tax effect accounting. So let's quickly recap on what we have considered so far. If you have an asset and liability where there are no tax consequences when you recover or settle it, the tax base will equal the carrying amount. Liabilities which is only deductible when paid, straight away tax base is 0. Okay, so that's what we take away from the previous part. Now I mentioned temporary difference, which is carrying amount minus tax base. There are two types of temporary difference. One is a temporary difference that is going to increase the amount of tax that you're going to pay in the future. That is a taxable temporary difference. And it gives rise, because it's going to increase the amount of tax that you're going to pay, it gives rise to a deferred tax liability. You have temporary differences that's going to reduce the amount of tax that you're going to pay in the future. It's to a deferred tax asset. And the screen here helps you work out what's a deferred tax asset or deferred tax liability. But you'll find that your spreadsheets or your software automates the calculation anyway. Okay, so in the next two slides, we're just going to look at the calculation of deferred tax liabilities on taxable temporary difference and deferred tax asset on the deductible temporary difference. So you got a piece of equipment that costs $2,000. The accounting depreciation rate is 10%. The tax depreciation rate is 20%. So tax depreciation is double the accounting depreciation. What would be the position at the end of second year, at the end of year 2? So we got equipment costing $2,000. Depreciation at 10% over 2 years is $400. For tax purposes, it's double the accounting depreciation, so it's $800. So you got a carrying amount of $1,600 and a tax base of $1,200. Gives you a temporary difference of $400. So accounting written down value greater than tax written down value. It is a taxable temporary difference. If you're going to sell it for $1,600, you make a gain of $400. That by 30% gives you a deferred tax liability of $120. So pretty easy concept. Just another quick simple one. If you had a provision for annual leave of $500, and I said provision for annual leave, add back, not incurred, not liability for tax purposes, tax base is 0. It's going to reduce your tax in the future, so it's a deductible temporary difference, and gives you a deferred tax asset of $150. Okay. So what have we done so far? We have looked at the calculation of temporary differences. Now what we're going to look at is, do you apply 30% to the temporary difference to recognize a DTA or a DTL? So that's the next part of our presentation. If you have a taxable temporary differences, generally you must recognize a deferred tax liability for it, generally. Yep. So there's no recognition criteria for taxable temporary differences. Now, you might have a deductible temporary difference, or you might have a tax loss. In order to recognize a deferred tax asset for those, you need to satisfy a recognition criteria, which says that it is probable that you're going to benefit from that future deduction or tax losses. That is, the term probable is not defined. Therefore, the consensus is that it's a 50% test. If it's 50% more likely that you're going to be able to benefit from that future deduction or that tax loss, you can recognize the deferred tax asset. So probable is quite judgmental, isn't it? But you need to put in front of you all the positive evidence against the negative evidence and work out whether or not you satisfy the 50% criteria. So things like, if you've got a history of losses, that's probably very bad for the auditors. They probably are focused on that. They look at management forecasts, and they look at your history of meeting that forecast. No point saying that you're going to make a lot of money, but you don't meet that forecast. You look at whether you have bought a business, planning to buy a business, look at whether your current position has changed or not. A very common question that I get also is, let's say you have revalued downward a CGT asset. And the question I get is, Daren, do you recognize a deferred tax asset for that? You can only recognize a deferred tax asset for unrealized CGT loss if you can show two things. One is that you intend to dispose of that asset in the near future. So you need to show that, demonstrate that intention. And secondly, you need to look at other areas on your balance sheet and show that you can dispose of another asset for a capital gain. Because no point having a capital loss if you can't use it. You can only offset capital losses against capital gains. So you need to show that two things before you can recognize the DTA for unrealized capital loss. So that's quite a common question during this GFC. Another question is, that's pretty unfair, isn't it? If you need to recognize a deferred tax liability, whereas you can't recognize a DTA, so it doesn't make sense. The standard says that you can actually recognize an amount of DTA to offset your DTL, so that in effect, you have a zero net balance. So that's how you get around that. All right? The fact that there's no recognition criteria for DTLs, but there is a recognition criteria for DTAs. So that's recognition criteria. Now we're going to look at recognition exceptions. So let's say you have a taxable, for example, a taxable temporary difference. It does not automatically mean that you need to apply the 30% tax rate to the taxable temporary difference and recognize the DTL. There are still way out of recognizing the DTL, and these are the recognition exceptions. The first one, the easiest one, is goodwill. When you see goodwill, don't recognize anything. All right? You do not recognize anything for goodwill. The second one is the initial recognition exception, and the third one is the recognition exception for investments, not just controlled subsidiaries, but investments, associates, joint ventures, and subsidiaries as well. We'll first look at the initial recognition exception. So the initial recognition exception cannot be used for investments. That's reasonable because you have one exception for investments. And it says that don't recognize deferred tax asset or deferred tax liability if the asset was acquired and it's not part of a business combination, and at the time of transaction it does not affect the accounting profit and taxable profit. Now, the easiest way to understand this is to look at a luxury car. So let's say you buy a car for $100,000. The tax base of that car, the depreciation that you can claim for a luxury car is 57,009. Let's just put 60K. Obviously, I've shown you from the previous example, I can't really count. Okay. Okay, tax base 60K makes it easier. Gives me a temporary difference of 40K DTL of 12K. By buying a luxury car, you have triggered a deferred tax liability of 12,000. Now, let's see whether the recognition exception applies. When you bought the car, were you buying a business or an entity with a business? The answer is no. So I satisfy the first part. That's what business combination means. When you bought that car, at the very moment you bought that car, did it have any impact on the accounting profit and loss or the taxable income calculation? The answer is no, because it's a balance sheet entry. So I tick that as well. So what that means is that although I have a temporary difference, I do not need to recognize a deferred tax liability for it. So very useful for a number of things. Luxury cars, sometimes you got a rollover of assets that's not part of a business purchase, pre-CGT assets and assets acquired from governments. Now we looked at the initial recognition exception. Now we're going to look at investments. So if you have an investment and its carrying amount differs from the CGT cost base of the investment, and that could arise because of revaluations or foreign currency translations, you do not need to recognize the DTA or DTL if the entity controls the timing of the reversal, the temporary difference, and it's probable that the temporary difference will not reverse in the foreseeable future. So what is up to us users to interpret what that means. So what we think that means is that you control the dividend policies of that investment. Okay, you have input into the temporary difference. You have the input into the dividend policies of that investment, and two, you control when you're going to sell that investment. So that's what the first bullet point means. Number two is you're not going to dispose of that investment in the near future, and it's unlikely that you're going to receive unfranked dividends from that investment. Okay, it's probable that temporary difference will not reverse in the foreseeable future. You're not going to dispose it in the foreseeable future, so you're not going to trigger a gain or loss, and you're not going to receive any unfranked dividends. Now I say unfranked because franked dividends are effectively not taxable, yeah, to a company when it receives that dividend. So that's the exception for investments. Do you have any specific questions there as well? And remember what I said about unrealized capital losses, whether you can recognize a DTA for that, that applies here as well for investments.
What sort of DTL can arise?
For example, if you got an investment in associates where you recognize your share of profits, so you go debit, investment, credit, share of profits in associates, it causes your carrying amount to differ from the CGT cost base. So that's one example as to when there could be a temporary difference, or you could revalue that investments. That could happen as well. This slide tells you that you can offset your DTA and DTLs, but in practice, they are shown differently in the financial statements. They're segregated out. And also, these are the things that you need to disclose in the financial statements. Like I said, from my dealing with a lot of multinational groups, the problem is not with the calculation of the current the income tax expense or deferred tax asset or liability. So you can see it's pretty straightforward, isn't it? What is doing this? The disclosure. The hard part is calculating your current tax expense, deferred tax expense to come with your income tax expense, and then tying it up to, your accounts has a prima facie reconciliation of tax where you start with 30% of your profit and then you make the adjustment. tying that up to your income tax expense. And the other thing is to reconcile your deferred tax assets, deferred tax expense, to your movements in your deferred tax asset and liabilities. That's the other second where you got to prove where on your balance sheet is it coming from, proving it. That is the most difficult part of it. And if you have a consolidated group, it's even harder. So I'm sure you guys know what I'm talking about there. So these are the things that you need to disclose in your financial statements, including the amount of DTAs and DTLs that you don't recognize in your financial statements.
Have you heard of the exciting development with Complete Tax Solutions? Complete Tax Solutions, CTS, is robust and powerful software designed to streamline the tax effect accounting, tax return preparation, and the financial and tax consolidation process for corporate groups. It contains many smart and innovative features, including connectivity with the client's accounting software, which improves integrity and increases efficiency. But we have not stopped there. CTS now showcases a new module, CTS Multinational. CTS Multinational provides a systematic and tested approach that simplifies the tax accounting and financial consolidation process for multinational groups. Simply enter in the functional currency, country tax rate, and the relevant spot and average foreign exchange rates, and see how CTS Multinational makes the tax effect accounting process so easy for you. CTS Multinational takes into account issues such as the effects of differential tax rate between Australia and the foreign jurisdiction, and changes in the corporate tax rate, and automated consolidation of the disclosure notes. The entity-by-entity display of the translated balance sheet will mean that, well, your client will have more time to deal with critical management issues. If you have any questions, please contact Daren Yeoh and the CTS team on 03 86 35 1994.
So first we're going to look at the direct recognition in equity. The best thing to do is to look at the example and then come back to this slide. Now, WSB 112 says that you need to look at your original journal entries that give rise to the temporary difference in deciding what your tax entries, what your current and tax entries should be, current and deferred tax entries should be. So the best way is to look at an example. We have a property, plant, and equipment with a carrying amount of 10,000, and it's revalued upwards to 16,000. Okay, and the tax written down value equals the carrying amount of $10,000. Now, so let's firstly calculate what the DTL is. We had a carrying amount starting with 10,000, so there weren't any differences there between accounting and tax. But once we revalued that asset, that doesn't do anything to our tax base. So tax base stays at 10,000. So we got a difference between the carrying amount and the tax base of 6,000, giving us a deferred tax liability of 1,800. So the question is this: we are crediting deferred tax liability by 1,800. What should the debit entry be? Now the standard says follow the original journal entry. So the original journal entry is to debit property plant and equipment by 6,000 and crediting the asset revaluation reserve by 6,000. So when you recognize the credit deferred tax liability, look at the original entry, they credited the asset revaluation reserve. So the debit entry goes to the asset revaluation reserve. Okay. Now, let's assume we start depreciating that asset. Okay, we're not using the revaluation model. We start depreciating that asset. As we depreciate the asset, our DTL will go down. Yep, you agree? Because now, as our deferred tax liability would go down, we'll go debit deferred tax liability. And the question is, what do we credit? And the answer is, it goes to deferred tax expense. Why does it go to deferred tax expense? Because your depreciation is going to the profit and loss account. Yep. So that original entry to the asset revaluation reserve, this stays there. It stays there until you dispose of the asset and then you move your entire asset revaluation reserve to retained earnings or capital profits reserve. So you always have to look at your original entry. So that's going back to the slides. ASP 112 require the current deferred tax to be charged or credited directly to equity if the tax relates to items that themselves were, the original entries, were charged to equity. So hopefully that makes sense to you. And things to look out for would be obviously that example that I've looked at, the revaluations. Sometimes you might have, there's a last point there, compound, that's pretty common as well, compound financial instruments, a convertible note, for example, where part of the face value is in liabilities and part is in equity. So you need to, sometimes you might change your accounting policies, and that entry goes against the opening retained earnings. So some of the things that could result in equity adjustment. That's the direct recognition to equity. Now we're going to look at tax accounting for tax consolidated group. That's another difficult area. The best thing for me to do is to give you the example first, and before I go through the slides, because the standards tends to use terminologies that are quite difficult to understand. So UIG 1052 governs the accounting for taxes for tax consolidated group. It basically tells you that you need to do bottom up. That's what Jason says. Each of your entity in your group needs to do their own tax calculation, something that you would already know. So you have a subsidiary, and it does its own calculation. And it has a few things. It might have deferred tax asset for temporary difference. It might have deferred tax asset for losses. It has its deferred tax liabilities, and it has its current tax liability or amount refundable from the ATO, a current tax asset. UIG 1052 says this. Once you have calculated the subsidiary's balance, certain balances are immediately assumed by the head company. So deferred tax asset for temporary differences, that stays in the subsidiary because it's based on the balance sheet of the subsidiary. So that stays there. Deferred tax asset for losses, that gets immediately assumed to the head company. Why? Because under consolidation, losses are immediately assumed by the head company. Yep, okay with that. Deferred tax liability for temporary differences, that stays with the sub's balance sheet, stays there. Current tax liability goes straight to the head company. Yep, because the head entity is liable to pay the tax. Now, so the subsidiaries needs to firstly recognize these entries, and then it needs to post an entry to show the assumption of certain balances to the head company. Sub, this is subsidiary accounting. Your sub has this entry, shortcut, income tax expense, 100, DTA, temporary difference of 20, credit CTL, 120. So as I said earlier, the current tax liability of the subsidiary is immediately assumed by the head company. Now, so the subsidiary needs to debit the CTL by 120. What do you credit? Now, if you have a tax funding agreement, and the tax funding agreement says that, yep, the sub calculates its current tax liability in a certain way, and it's assumed by the head, and the subsidiary will pay you for that assumption. If you have a tax funding agreement, then it's very simple. It goes through a loan account. Yep. If you don't have a tax funding agreement in place, then it goes to a fictitious share capital account. Yep, in the sub entity. Very confusing, very difficult to explain to the board. So you're better off having a tax funding agreement. Yep. For head company accounting, you recognize the CTL of the subsidiary. If it has a tax funding agreement, it goes to a loan account. If it doesn't, investment in subsidiaries. Okay. One thing to know about tax funding agreement is that the ATO view, I've seen a lot of tax funding agreement where the effective date of that tax funding agreement purports to apply from the date of consolidation, and you execute it 3 years down the track. Just bear in mind that the ATO's view is that they don't accept effective date that starts before you sign the agreement. So just bear that in mind, but it is done in practice. So the earlier you have your tax funding agreement, tax sharing agreements in place, the better. Now, if you have, I spoke about current tax liability. If the subsidiary has a DTA for losses, let's say DTA for losses of 100, it needs to de-recognize that DTA of 100, and then it debits. If you don't have a, if you have tax payment, yep. Head company treats it as a dividend income. So better off having a tax funding agreement in place. So hopefully this will make the next few slides easier to understand. The subsidiaries will need to, on a bottom-up basis, record their own tax effect accounting entries, regardless of whether or not you have a tax funding agreement in place. Record your own entry first. The second bullet point basically says that you need to have a bottom-up approach in calculating your taxes for the group. Now, when you, from a consolidation standpoint, you're a single entity, how do you go about calculating the taxable income of a subsidiary? UIG 1052 doesn't prescribe the method that you have to follow. All it says is that, well, we know of 3 approaches that you can apply. The first one is a standalone approach. The standalone approach, basically, you prepare the tax reconciliation statement as though the subsidiary is a single entity separate from the group. That means that if you have intercompany sales, for example, that is tax affected as well. You treat it as taxable. The second one is the same as the first one, except that you recognize that for tax purposes, intercompany transactions are not recognized for tax purposes. So you don't tax effect intercompany sales, for example. The third one really is one of the 2 approaches at the top, frankly speaking. My preference is to use the first approach. Yeah, the first one more accurately reflects the economic performance of the subsidiary. If you use a second approach, and all it has is sales to intercompanies, it will not have a tax expense balance. Yeah, because you don't. So you end up having companies that have a greater tax expense than and the subsidiary doesn't have any. So the first one is probably the my preferred approach. As I said, subsidiary recognize everything, DTAs, DTLs, CTLs. The CTLs, the current tax liabilities, and deferred tax of losses need to be de-recognized immediately because it is assumed by the head company. If you have a tax funding agreement and how you calculate the amount assumed, okay, it's the same as your CTL calculated, then if you don't have a tax funding agreement, then you have equity adjustment, share capital or dividends paid. If you have a tax funding agreement, then it goes through the intercompany loan account. So much simpler. What about the head company? It recognizes its own DTAs and DTLs, and it also recognizes assumptions of the subsidiaries, CTLs and DTA for deferred tax asset for losses. One thing that Jason hasn't shown you is that CTS does that as well for tax consolidated groups. Okay. So next I'll go through what most of you are here for. You guys are probably familiar with tax effect accounting, but you do want to hear about what has changed with AASB 112 and what is going to change and where things are at with AASB 112. Now, a bit of history. We apply the international standards, and so there's a lot of companies globally. The US has their own standard, and they do not want to adopt the international standard. I think the winds are changing at the moment, but at the moment they have their own standard. Companies that are dual listed, let's say listed in Australia, for example, they need to prepare accounts under the international standards, and then they need to translate it and to lodge it with the US, prepared and according to the US standard. That costs a lot of money, billions of dollars. So what the International Standard Board and the US Standard Board wanted to do was to converge. US wasn't going to use international standard, but make it the same, as close as possible. So they came out with an exposure draft back in 2009, and the objective was to reduce the differences between the two standards. Obviously, you know, GFC hit, and the US had other priorities, so this became less important. So for the International Standards Board, they say, well, okay, what we'll do is let's reduce the scope of the project and let's focus on practical things, things that corporates are finding difficult. So the thing that has gone through is the change in relation to management intention as to sale or use. The one that I've discussed earlier. So they have released an exposure draft on the recovery of asset, and that has gone through AASB 112. It applies, IAS 12 is the international standard. Ours is really a mirror of it. Applies from 1 January 2012. So before I go into the changes that has gone through and will come through, as far as the International Standards Board is concerned, the tax project is completed. Okay, we get a bit of a rest at the moment. But there will be fundamental changes to AASB 12, AASB 112, IAS 12 in the future. So let's quickly go through what has changed. So this change has gone through. So the change basically says that there is a presumption that you will recover the asset through sale if you account for the asset under the fair value method under SB 140. So if you have an investment property, you recognize the carrying amount at fair value or market value, and that fair value movements goes to the P&L, there is a presumption that you recover it through sale. So you always use the CGT cost base as the tax base. Also, if you have a non-depreciable asset where you apply the revaluation model under 116, so you revalue an asset and you revalue the asset at fairly regular intervals, there is the presumption that you recover it through sale as well. Presumption can be rebutted, okay, if the asset is depreciable and there's clear evidence that the entity will use the asset throughout its economic life. So but the asset has to be depreciable. So land will always be recovered through sale because land is not recoverable. Land is not depreciable. Okay, so now I'm going to cover things that the International Standards Board says are complicated things, practical difficulties that they are going to change, but in the future. So one is they plan to introduce an initial step. You got to ask yourself, hey, if I recover the carrying amount of asset, if I pay the liability, I'm not going to pay any tax. For example, in New Zealand, no capital gains tax. Okay, if you're not going to pay any tax, then you assume that tax base equals carrying amount. So there's plan to introduce that. So this is a major issue for a lot of international companies that can rely on participation exemptions when they sell shares in a company, and they can rely on this exception, this initial step. Also, this is purely disclosure, a valuation allowance. You remember I said you can not recognize DTA. Well, this one just asks you to display that differently. A valuation allowance is like a negative accumulated depreciation. So what you do is you show the DTA, total DTA of the group, and then you have a negative value allowance for the DTAs that you do not want to recognize or can rely on the recognition exceptions, and then you do have the net balance of the DTA that you do recognize. So that is it just provides a better reflection of your actual positions, and it's more consistent with the US standard as well. Okay, finally, the last point is accounting for tax uncertainties. Unfortunately has not gone away, but few has been deferred, okay? And it is deferred until they have dealt with the issues in IAS 37 in relation to contingent liabilities. Uncertain tax is a contingent liability, so falls within the definition. So they're gonna look at the IAS 37 project first, finalize that before they even think about accounting for tax uncertainties. That's why the ATO has the reportable tax payments schedule, and you guys have to fill that in. So that is similar to this disclosure. So accounting for tax uncertainties, the Standard Board says yes, we will put that through. Okay, we will put that through, but we'll not consider it until we have revised IAS 37. Now, tax law is uncertain. Even the capital, whether you have disposed an asset on capital account or on revenue account, that has gone on for ages, and it's still going now. You look at your AAT cases, federal court, we're still arguing that revenue versus capital dichotomy. So our tax law itself is uncertain. Then you overlay that with things that you might be claiming losses, you might be relying on exemptions or rollovers, and the ATO might not necessarily agree with your application of those exemptions. So these things create uncertainty in our tax position. And this is exactly the thing that the ATO wants you to report on the ATO reportable tax position schedules, which applies to the top end of town. And so when it does come in, you need to you got to work out what is the probability of the tax that you're gonna pay, right? And based on that probability weight, recognize some CTL that is uncertain. Okay, and in the US, you're gonna recognize penalties and interest as well. It's not so clear whether IAS 12, when it does change, require you to do that as well. Apart from that, you will also need to describe what that uncertain tax position is and the financial effects on tax. Now, you already know that this is like a gold mine for the tax office, isn't it? It's clear. It's already happening in the US. People are going to court trying to stop the tax authorities from assessing the what's called FIN 48, this accounting for tax information. And once the ATO has get their hands on it, you are basically telling them where to look, basically. And this is an example of how you calculate the uncertain tax position. Let's say company with a profit of with an operating profit of 5,000, everything is fine except an uncertain amount with respect to a $3,000 deduction. 80% chance that you get a deduction, 20% chance you get denied the deduction. A very simple example, just to demonstrate how this works. So you end up with a probability weighted deduction of 2,400. That means there's a risk that probability wise, $600 of uncertain amount. So this is under the current standard. Proposed standard is that effectively you're recognizing a deduction for 2,400. Your current tax expense is higher by the uncertain amount of $180. So you quantify that, journal that through, and have the relevant disclosures. It's highly contentious, obviously, and you do need to have a think about it when it does come very close. It's likely to trigger inquiries from analysts. You know, why is it's going to result in fluctuations in your income tax expense, so, and it's going to probably, analysts going to ask, why is that happening? You have greater record keeping obligations, explaining why it's uncertain and why, justifying the probability weighting that you apply on it. And that does come out like FIN 48. It doesn't say uncertain tax positions from this date. It just say record all uncertain tax positions. So you got to go back. Okay, when FIN 48 came out, I've seen companies going back 7 years to record the uncertain tax positions. So you might want to have a good practice of preparing your documentation now. So I don't see this as something that's going to be 5 years away. It's probably 2 years away. But okay, so that's brings us to a conclusion. We have looked at the mechanics of the balance sheet approach. We look at the calculations of deferred tax asset and liabilities, and when you don't have to recognize those balances. We have looked at equity adjustments, tax consolidations, and changes to WSB 112. And I'll be around if you have any questions, and I thank you all for coming. Thanks.